opposed to a single restaurant, a food court offers variety. It has something for each one. Likewise, as opposed to a single investment option or a single investment product, mutual funds have different types of schemes for different investors. But aren't all mutual funds the same? After all, it's mutual fund investment, right? There are many people who carry this misconception that all mutual funds are the same. While on the other hand, we certainly have those people who are often in a dilemma: which mutual fund should they invest in, or which mutual fund should they choose to invest in? Hello guys, my name is Namita. Welcome to yet another video, and in this video we are going to explore more in detail about different types of mutual funds, particularly what is the difference between a debt fund and a mutual fund, and where should you invest in and when. So first of all, broadly there are three types of mutual funds, which is equity mutual fund, debt mutual fund, and also hybrid mutual funds. Mutual funds offer a wide range of investment solutions for different investment needs, investment tenures, as well as the risk appetite one holds. Different investors have different financial goals and also risk appetites depending upon their stage of life as well as the financial situation they are currently in. Also, say one investor can have multiple financial goals at any point of time. To select the right mutual fund scheme for specific investment needs, you need to compare the different assets as well as see which one will suit you the best. Equity mutual funds, let me tell you, are the most popular and also the common type of mutual funds in India. They are also known as open-ended equity funds. Equity funds provide the investors with the opportunity to invest in, say, listed as well as unlisted companies which have equity shares that can be bought and also sold at any given point of time. Now here, if you talk about the returns you get on equity investment, it will depend on the performance of the underlying stock market indices as well as the other factors such as the government regulations, the government policies, etc. Equity funds usually invest in, say, large companies with high market capitalization. Now you must wonder what exactly is market capitalization. Here let me tell you, it actually refers to the value of a company, a particular company that is traded on the stock market, which is calculated by multiplying the total number of shares by the present share price. Now for an instance, let's take a company which has 20 million outstanding shares and the current market price of, say, each one share is, say, rupees 100. So here the company's market capitalization will be rupees 200 million, which is 20 lakh into 100, which is 200 crores. So the advantage you get by investing in equity fund is that you get higher returns when compared to debt funds as it invests in more mature companies. Thus, it becomes more ideal for the long-term investors who want to see their money grow over a period of time, say once they retire, or even it is also ideal for those who are not doing, say, a full-time job. Equity funds are known to generate better returns than term deposit or even the debt-based funds. But let me tell you, there is a lot of risk which is associated with these funds, as their returns or the performance will depend upon various market conditions. So when you're investing in mutual funds, when do you actually consider it to be an equity fund? Well, let me tell you, you do it basically when the equity exposure is more, which means that it is if the equity investment is, say, more than 60% of the total assets in the equity share of different companies. And the remaining 40% will be invested in, say, money market instruments or even debt securities as per the investment objective of the scheme. Now let me take you through some of the important factors that you need to consider whenever you are investing in equity mutual funds. So the very first one is the fund size. Yes, this is an important factor that you need to determine when you're investing in equity funds, as it will give you a fair understanding, a fair idea as to how much of money you can invest in it. You should consider the size of the fund if you want to invest in, say, large amount of money, and if you're investing, say, small funds, then this might not give you the expected returns. That's why you need to determine the fund size of the company that you're investing in. The second factor is the expense ratio. Now this is yet another important factor to consider when investing in equity equity mutual funds. And here the fees that you will be paying to the fund manager will basically depend upon the number of mutual fund units that you're planning to purchase or you have purchased. So you need to consider the expense ratio, which is the fees you will be paying. So if there is more fees that you're paying, then it will mean that the return you will get will be ultimately low. And the third factor you need to consider is the risk reward ratio. So what is that? Basically, the risk reward ratio is the measure of the return in terms of the risk for a specific period of time. You need to determine this, since the risk reward ratio determines how well they will perform over a period of time against the other investment that will give you the same amount of returns but with less risk which is attached to it. Now moving on to the next one. The next one is debt mutual funds. Now what are debt mutual funds? Well, debt funds are basically all about the investment in the money market. You might have heard of commercial papers, you might have heard of non-convertible debentures, the government bonds, etc., which are the examples of debt funds. The main goal of the debt funds is to get the interest payable as the regular income. So if you're looking for a regular income, then debt funds is ideal for you. Now the best part here is that with the change in inflation, the debt mutual funds are not prone to fluctuations that will increase the demand among those who do not want to take a lot of undue risk in the short period of time. So here not much of risk is associated. Thus, debt funds are usually recommended to those investors with low risk appetite. Now here let me tell you, the debt funds are available in A. You can do it for short period of time, which is short term, which will be for 3 to 12 months. So rather than keeping your money in, say, savings account, you can instead invest in liquid funds, which will offer you 7 to 9% of returns. And the second one is midterm, which is ideally for 3 to 5 years. Now, when you're looking for an investment option, when you're looking to invest in, say, low risk investment for a period of 3 to 5 years, then you must be thinking, okay, let me put my money in, say, fixed deposit. But here, rather, you can invest in dynamic bond funds for a same period of time, but for higher returns. If in case you want a monthly payout, you also have the option to opt for monthly income plan. Now let's move on and understand what are the things that you need to consider before you're investing in debt mutual funds. So the very first one is expense ratio here. So this is the total amount that you will be paying for the mutual fund. Now this will be inclusive of both the fees that you will be paying to the management as well as the other, which includes the cost of operating cost as well as the transaction cost. The second factor you need to consider is the management fees. Now this is the money that you will be generally paying to the fund manager who is in charge of managing your money, managing your investment, who is paid a certain amount of the money that you have invested. And the third factor you need to consider is the risk appetite. So these are the three main factors that you need to look into if you're investing in debt mutual funds. Moving on, let's understand in detail what are the major differences between these two asset classes. So the first difference between equity funds and debt funds comes in terms of the investment. Equity funds primarily invest in the shares of companies that are traded in the stock market. They also invest in securities like futures, options, etc. Therefore, equity funds are a volatile asset class when compared to debt and are suitable for investors with high risk appetites. While on the other hand, if we talk about debt funds, then debt funds primarily invest in debt. The money market instruments include commercial papers, treasury bills, certificates of deposits, and debt market instruments include government bonds, non-convertible debentures, and government securities. These funds therefore focus on generating regular income. However, some debt funds may help with the capital appreciation for the investors as well. Now coming to the second difference, this is in terms of returns. Well, returns for equity funds are higher when compared to debt funds in a longer term. On the other hand, if we talk about debt funds, here the returns are low to moderate in comparison to the equity funds. The third difference comes in terms of risk appetite. While investors with moderately high to high risk taking capacities are advised to invest in equity funds. On the other hand, investors with low to moderate risk appetites can invest in debt funds. Now, when talking about expense ratio, the expense ratio of equity funds tend to be much higher as they are actively managed by the fund managers. On the other hand, when we talk about debt funds, here the expense ratio is low in comparison to equity funds. Next difference comes in terms of investment duration. So, when you are talking about equity funds, they are a long-term investment option which is suitable for achieving long-term financial goals. While on the other hand, the investment duration of debt funds ranges anywhere from first day, 1 day to many years. You can select them as an investment alternative to fixed deposits and also the savings bank accounts. The next difference is taxation. Now when you're investing in equity funds, let me tell you, you will have to pay 15% tax on capital gains from the equity funds if you hold them for less than say 12 months. Consequently, capital gains on holding equity funds for say more than 12 years, which is more than 1 year, they are tax exempt up to rupees 1 lakh, which means if the capital gain you have got is less than 1 lakh, then it is exempted from tax. And if you make a gain that is beyond rupees 1 lakh, then you are taxed at 10% rate. On the other side, if we talk about debt funds, then you will have to pay short-term capital gains tax if the debt funds are held for less than say 36 months. Consequently, tax will be levied at the income tax rate applicable to you. If you hold a debt funds for say more than 36 months, you can avail for indexation benefits as well. Long-term capital gains here are taxed at 20% rate post allowing the indexation benefits. And the last difference between these two comes in terms of tax benefits. Well, when you're talking about equity funds, then here let me tell you, ELSS mutual funds will allow you tax savings by investing say up to rupees 1.5 lakh in one financial year. On the contrary, if you are talking about debt funds, then here you do not get any kind of tax benefits or you save anything from the taxes. You will have to pay a certain kind of tax whenever you are making any gains. So in this video, we have discussed difference between equity funds and debt funds and also what are the characteristics of these two funds. Mutual funds are one of the most friendly investment options provided you are able to compare equity mutual funds and also debt mutual funds and which one is ideal for you. While equity funds are risky in the short period of time, in the long period of time, they can definitely provide you superior returns over any other asset class provided you are ready to take that high risk with your investment. On the other hand, let me tell you, debt funds can be your good friend if you cannot tolerate high risk and you're happy with low to moderate return, and if your main goal, if your main aim is capital protection and not capital appreciation. Debt funds are also an alternative investment for fixed deposit as well as the savings bank account. Lastly, both equity and debt funds are tax effective investment options when compared to any other asset classes. So I hope from this video you have got a fair understanding of whether you need to invest in equity mutual funds or you should go for debt mutual funds. Also, if you want to learn in detail about more such mutual fund investment, how you can plan it, you can download Freedom app from Play Store or App Store, wherein we will give you A to Z details from scratch, how you can invest in mutual funds, how you can invest in stock market, how you can invest in any other safe avenues. So download Freedom app from Play Store or App Store, and also the link is given below in the description box, which you can click and download Freedom app. So if you have liked this video and if you have found this video quite informative, then do not forget to hit on the like button and do let us know in the comment section how you like the video and what are the other topics you would like us to cover. Also, do subscribe to the channel and do not forget to hit on the bell icon so that you are notified whenever we post any such important videos for you guys. Thank you for watching Freedom. Get wise, break free.